Good afternoon from the Shreveport office of Eagle Financial, a wealth care company, for the latest edition, the November 18th, 2022 edition of the Jack and Bill Show live.
Woohoo! It's been a while since
Okay.
we've been together on the show.
Yes,
Yeah.
it has been. And now last week, you how did the Bigfoot hunting go last week?
I don't even know where you got that. First of all, there is no Bigfoot in Arkansas. It's the Fouke monster. Everyone
The
knows
Fouke monster.
about the folklore of the Fouke monster.
And that's about an hour from here.
Yeah.
Yeah.
I mean, if he wanted to, he could make the short drive to Shreveport.
The Fouke monster. That's Fouke. There's a
No.
town there. That's not it?
No, Faulk
I think there's a
Oh,
silent
or
Q.
Fauk, or I don't know what I'm
Well,
talking
it's on
about. Jay.
I-49 about an hour.
That's
from
correct. That's
here.
correct.
Okay,
Hey, before we get started, can I give credit where credit is due?
sure.
Wesley, behind the camera, has done some phenomenal work here recently. Not that he hadn't before recently, but he's really done a good job with the social media. And Wesley, one Werther's Original, sugar-free. Thanks, buddy. Okay,
Is that my bonus?
that's your bonus.
Well, I think we've got a special treat this afternoon because William has written a market commentary entitled "The More Things Change, the More Things Stay the Same." So he's going to talk through some of this stuff. We've definitely had profoundly interesting markets, to me. We've had rally the last couple of weeks. In fact, I'm looking at today's Wall Street Journal, and we can see that the Dow Jones Industrial Average and the S&P 500 have busted back through the 65-day moving averages on the upside. So those would be short-term buy signals. And the NASDAQ market is right there, busted through it earlier in the week and is below the 65-day moving average right now. And the NASDAQ markets are still selling at 24 times trailing earnings, with the Dow and S&P much cheaper at around 20 times and yielding significantly more. The yield of the Dow is over 2%, and the S&P around 1.7. So, with this rally, we've seen, I guess on the lows, the S&P was down intraday somewhere around down 25% this year. I think that was back around June the 17th. We tested that again recently, end of September, and then we've rallied. S&P today up 0.48%, call it a 0.5%, and that's bringing us year to date down 15.5%. The Dow up 0.6% today, and the NASDAQ flat today. So, we've seen one of the big stories this year that we've reiterated. The Dow Jones Commodity Index and commodities in general up sharply, really mostly because of energy. Crude oil up about 10% this year, and nat gas up about 70% at the around the 635 level. And we've had gold rallying recently. Was down about 10% on the year, and it's only down about 3.5%, now. So that's the other thing. What's driving this whole thing, and I'm going to let you get into it, Bill, is I think we've shared this previously, both the stock and bond markets are really held hostage to the CPI and PPI, or finished goods and wholesale goods price inflation movements. So inflation is just defined as a general rise in prices, and this year we've been, above an 8 handle, 8 to 10% most of the year, and the CPI came in a week ago, more than a week ago, down to 7.7%, better than expected. The PPI coming in this Tuesday at 8%, 8.0, better than expected. And if you had a crystal ball on what those two numbers are going to do for the next 6 months, you'd have a pretty good feel for what the stock and bond markets are going to do. So that's, Bill, I talked to 2 fund managers on the phone today, or 2 bond shops, I should say. And one of them was telling me about there's two lines of thinking out there. One is what's coming from Jerome Powell and the Federal Reserve, and that's that they're going to do everything humanly possible to get inflation back down to their target is 2%. Since 1926, the inflation rate has averaged more like 3%. And then the other school of thought is really coming from people that manage money, both the buy side and the sell side. The mutual fund industry, their commentaries on the bond market, and they've got a much more bullish picture. And of course, they're going to be biased because they want you to send them money. So with that, start us off, William.
Where to begin? I'll start with some feedback from clients on the phone this week. We learn a lot talking to clients. We learn a lot about investor mentality talking to clients. I was talking to one person this week who made a comment that this is a bad market. Why would I put more money into this? It's a bad market. To which I asked the question, well, how do you define what's good or bad? The market is on sale, correct? Could the sale deepen? Yes, it certainly could, before it eventually recovers. But if I were to say to you, there is a 25% off sale at name your favorite store, you would get excited about that. You would run out and spend money. But if I were to tell you that the stock market is 25% off, most people would not get excited. They would get fearful. And that's what we're seeing this year. A lot of fear in the markets. So it's a good time to think about why you invest, the purpose of taking risk, how long you can commit yourself to investing, and take a deep breath. These things happen. And for anyone who's been in the market for a while, you have witnessed this time and time again. Let's go back to the technology bubble, the late 1990s, 2000. We saw a big sell-off in stocks, mostly technology and telecom stocks. Then we had the credit crisis, 2007, 2008.
Those were 50% decline.
That's correct.
2001, 2001, 2002. Down 8%, down 11%, down 22%, cumulatively down over 50. And in 08, 09, we were down like 55, 56%.
Right. I mean, how would you like to wake up and one day your investment account is cut in half? Well, that's basically what happened with both of those events. And what ensued after? Markets recovered. Then in 2020, we had the COVID lockdowns, and we saw the US stock market decline 34% peak to trough. Another big sell off. And the markets recovered and hit all time highs. And then in the beginning of this year, we started to see weakness in the markets. We wrote about it in our market commentary. Basically, inflation was roiling and the Fed got caught on its back feet, on its heels. The Fed was late to respond to inflation. It held the Fed funds target rate at 0 for too long. And all of a sudden, inflation's at 8%, and the Fed has to do something about it. And so what the Fed does is it uses very blunt monetary policy tools to engage economic growth or to throttle back economic growth, depending upon the situation. In this case, with inflation raging, the Fed needed to throttle back economic growth because their primary mandate is price stability, which is keeping inflation in check, because inflation is a horrible thing for consumers. So they did that. They raised the Fed funds rate and kept raising it and kept raising it. And we saw a sell-off, as you said, Jack, in both stocks and bonds. And that can be troubling for investors because we've grown accustomed to bonds receiving flight to quality money flows as stocks are selling off. So bonds traditionally have been the safe haven. Not this time, because the risks of inflation and rising interest rates negatively affect both asset classes, stocks and bonds.
Unless you own adjustable rate bonds.
That's true. That's true. So then it begs the question, why do we subject ourselves to this? Is this just madness? Why do we put ourselves in a position as investors to ride these ups and downs and get whipsawed like this? It's a great question. And the simple answer is that when we are investing, we are taking money, putting it aside. We're delaying consumption today to save for something in the future. And we could put that money in the bank and we'll earn a small nominal return on that money. But if we take investment risk and invest in things like bonds and stocks, we can expect to earn higher rates of return on that money. There's a great tool that is so simple to use. It's called the Rule of 72, and it's a way to calculate compounded growth. So this is how it works. You have 72, and you divide your expected rate of return into the number 72. So Jack, you said earlier that over the long run, inflation has averaged about 3% per year. Well, let's just say that you're satisfied growing your money by about the rate of inflation. You want to maintain purchasing power. You're not looking to grow. You just want to maintain. So if you earn 3% per year, all right, well, you divide 3% into 72, and that gives you 24 years. Basically, it would take you 24 years approximately to double your money, earning 3% a year.
Well, let's redefine that.
Go for
That's
it.
the same way as saying that in 24 years, you need to have twice as much money as you have today to maintain.
Oh, that's good. That's good.
Okay.
Yeah, that's a good way of evaluating the effect of inflation on purchasing power.
So, because we've just said from 1926 to present, CPI inflation has compounded at about 3% per annum. So in your example, if you're compounding your money at 3% per year, you've actually gone nowhere.
You've gone nowhere.
And
you've maintained.
You've probably paid taxes on that.
That's correct.
So,
That's correct. But no, that's interesting. You point that out though, because if let's just say that you're curious what cost of a vehicle will be in 24 years' time. Well, just based on the rate of inflation, it will be about double in 24 years what you would pay in today's dollars. So that's if you're just maintaining. But let's just say you're willing to take a little bit of risk and invest in bonds. And let's say you earn 5% per year return. Well, if you can earn 5% per year return, it would take approximately 14 years to double your money. That's a lot better than 24. Now, what if you were willing to take more risk and invest in stocks? And let's say that you earn 10% a year. 10% a year, divide that into 72, it would take approximately 7 years to double your money. 7 years to double your money in stocks versus 14 years for bonds versus 24 years for, let's say, cash equivalents. Now, there are a lot of assumptions baked into that, and there's nothing guaranteed. I'm just citing these to illustrate why we take investment risk. And for people who have time on their side, especially younger investors, and you have decades ahead of you, you are so much better off taking market risks and to buy when the market's on sale. What a deal. We don't get these opportunities very often.
I would say this. Let's see. I mean, you look at what mortgage rates have done since. Now this is painful, but I know somebody who bought a house in December and financed it at 2 3/8%, and that rate today climbed higher than 7% and is around 6.6%, today. But I actually think it's likely that we're going to see those rates move a little bit higher, even though they've come down here in the last month. But so the other side of that is what you can do as an investor, because in December you were getting like 0.25%, something like that, on a short-term treasury. And I bought a 15-month treasury note paying 4.72% last week. So that's 4.7.
Yeah.
So that's actually very attractive. I mean, we have a lot of clients that haven't wanted to allocate to fixed income, and you can do very safe things in the fixed income markets now. You use, Bill, the 5% number in your analogy of doubling your money in 14.4 years. We can actually do that.
We can.
We can do that.
Now, that 4.7% that you locked in on a treasury,
Yeah.
would you say that was the peak of the yield curve?
That may have been. That was the peak of the yield curve out to 2 years. I can tell you that. And the 2 years yielding more than the long end. So that was the peak of the yield curve.
Okay. So when we look at buying bonds, we look at the yields we can garner at different maturities. And so when we talk about the yield curve, we're talking about a graphical representation of yields at different maturities. Normally the yield curve is upward sloping because you expect to be compensated for your time. When you buy a longer dated bond, you would expect to earn a higher yield. But there are times like now where the yield curve is inverted. And so shorter term bonds are yielding more than longer term bonds. So we can target the peak of the yield curve to get the highest yield. And it just so happens that right now it's around the 2-year mark.
15 months.
15 months. But that begs the question, should we just only buy short-term bonds? And there is a risk when you are being too conservative with buying bonds and you focus only on short-dated bonds, that what will happen is the yield curve will adjust, its shape will change. And these bonds that we're buying do mature, and now we're faced with reinvestment risk. We have to put that money to work at the then prevailing rate. And so it could be that in 2 years' time, when this short-term bond matures, rates could be lower.
Oh, let's just give a real world example. the U.S. economy goes into recession and the Federal Reserve decides that, let's just say CPI inflation comes down at the same time, or they give up on inflation and decide that they don't want to have a horrific recession or something worse. So they ease the Fed funds rate from the 3 3/4 to 4 range where we are today, and they move it back down to 0.
That
So
could happen.
then your bond, you locked in at 4.7%, and the Fed funds rate goes back down to 0, and you go to reinvest that money, and you're back getting nearly
nothing.
nothing.
You know, Jack, when you earlier you cited 7% mortgage rate, and it's kind of the flip side of, you know, do I invest in the markets now because, you know, the markets have been under pressure? Well, if you're in the market for a home, are you going to delay your purchase because mortgage rates have gone up? You might. There are people who will be priced out and won't be able to afford the home
At the margin.
at the margin. Or maybe they have to settle for a smaller home. And they're not buying the house of their dreams. They're buying something less. But we've seen double-digit mortgage rates before. You know, in the early 1980s, people were paying double-digit mortgage rates, and they were still borrowing, and they were still buying houses. And so what would happen is, as rates would come back down and normalize, they would just refinance the mortgage. So if someone needs a house, they need to buy a house. And the rates are high right now. But at some point in the future, we would expect the rates to be lower and you refinance your house. It's like with investing. So the markets are having a tough year this year. It won't always be that way. And we can't time when the markets recover, when they're going to correct. The key
No.
is to be in the markets. And especially for those people who have time to invest, time on their sides, you need to be in the market.
That's exactly right.
I had another interesting comment from someone I talked to this week. This person said, well, I heard that because the markets are bad, I shouldn't put money into an IRA. No, I mean, I get it. I get it. Well, I just had to explain and provide some education. An IRA is just a savings vehicle, and you can buy whatever you want inside of an IRA. You can have stock exposure, you can have bond exposure, you can have cash, precious metals, whatever you want. So the IRA in and of itself is not a negative thing. It's actually a positive thing because it's a vehicle where you can save and invest tax deferred or maybe even tax free if it's a Roth. So, and something else that I have been telling people, and it's in this market commentary, is that no matter what's going on in a particular market, there's always a place to invest. The stock market garners a lot of attention. There's just something sexy about it. But the stock market globally is not the largest market. The global bond market dwarfs the stock market. And I guess you could also throw in currencies. I mean, that's a huge market. But there's always some place. And yes, this year has been challenging because stocks and bonds have both sold off. But there are places to make money, and it's our job to find those places.
Oh, that's good. That's good, Bill. And we've actually, this is kind of interesting. I'll just say this generally speaking to our clients. What we're doing between here and year end, we're sending people their required minimum distributions from retirement accounts. That's the thing. I was pondering this when you're talking about a person, delaying putting money into an IRA. These are long dated
That's right.
investment vehicles. And historically, IRA assets are passed down from generation to generation. And that's still a wonderful place to build wealth, whether it's a 401k plan, or an IRA. these are long dated places to accumulate wealth in a tax deferred or even tax free means
That's
if you're
right.
using a Roth 401k or a Roth IRA. So, yeah, I forgot where I was going with that.
Well,
William.
here's something else, because we were talking earlier about Fed funds, and now cash yields are very attractive. We've been touching on this on past episodes, and I'll say it again. For someone who just wants to do better on their money than what they can get at the bank, say for their rainy day fund, their savings, or for businesses that need to maintain large cash balances, this is the time to be thinking outside of the box, because yields on money market funds are over 3.5%. We can buy short-term treasury bills, get 4% plus, not taking any risk. So the banks are always slow in raising the rates that they pay their depositors when the Federal Reserve is raising the Fed funds rate.
Yeah, the average money rate, whether we're talking about CDs or money market interest rates paid by banks, I could try to find it here and look it up.
Mm-hmm.
I mean, it's not even in the ballpark of of what we can get. That was the other thing I was going to say, Bill. So we're doing our year-end RMDs, and we're also doing tax loss selling. Actually, most of our clients have gains in their accounts because we rotated out of some of the high flying things back in January, not anticipating that the market would sell off. We're really agnostic, on that.
But rebalancing, selling that which has gone up the most, and rotating into some things that have underperformed.
Right, that we felt had, they certainly had much better valuations. And we've actually got our largest equity holding is an ETF that is takes the 100 largest stocks in the Russell 1000 large cap index, and it quarterly rotates in the cheapest ones, or the ones that sell at the highest multiples of free cash flow to enterprise value. And that fund was up 42% last year, market beating in a huge way. And it's made money this year and pays. Those are performing companies that generate a lot, of free cash. And I think so. But we've been very diversified, and where you talk about the only place really to hide this year has been the commodity space.
Yeah,
I mean, you could
alternatives.
Alternatives. We've had 2 business development companies that have been taken out, and that's been a wonderful, positive surprise. Actually, we've had 1 taken out and 1 in the process of being taken out. And then we've owned algorithm run funds in the commodity space that are up anywhere from 15 to 25% so far this year, after gains last year as well. So we've actually the bond market is down. I'm looking at the Dodge and Cox Income Fund, which
We don't own.
We don't own it. It's an intermediate term investment grade bond fund that's enormous. It's down 11.6%. It went down in value today, with yields bouncing back up a little bit. It was down as much as 14 or 15%, a month ago.
Mm.
And the Vanguard total bond index is down 13.6%. So I do think, this goes along with what you're saying. Anytime you have, that's actually historic.
Oh yeah.
I mean, this is like the worst bond market
Ever.
in U.S. history ever. So, I mean, for the Fed to raise interest rates from 0 to 3.75 with another 0.5% rise forthcoming next month. I mean, that's unheard of. And there has to be, and that's what we do. We find the opportunities under these scenarios. So, and I think that we're going to have we're going to have much greater vision during the next 6 months, I believe, on where the Federal Reserve is going, what the inflationary numbers are doing. But if you wait until you know,
Then you're missing out.
if you wait until you know, that's right, you will have missed out because the markets will have already rallied.
Mm-hmm.
So,
You have to go against your instinct. The most successful investors, I mean, the people like Warren Buffett, for example, they are successful because they've been willing to take risks in the face of fear.
yeah, exactly. You want to do when your gut is churning. You want to do the opposite of what you're feeling. And Bill and I really don't. When I started out in the business, it was easy to get caught up in that. But I don't get excited on up days or depressed on down days. We view that as opportunities. On up days, we might be trimming things
That's
that
right.
have done especially well and looking at those things that are quality, that have been beaten up.
Well, I'd also say that because of our experience between the two of us, we have a lot of experience and we've made our share of mistakes over the years.
That's how you learn.
That's how you learn. And we've learned some tough lessons over the years, and it has helped us as investors. So having that experience, we can put that to work for you.
Well, Bill, is that pretty close to a wrap?
I think so. Wesley's signaling that his stomach is churning.
Okay. I've got to throw one thing out there that I discussed last week. The LSU Tigers did struggle a bit with Arkansas.
Yeah, it was cold.
And I did outline a way, hypothetically, to get 3 SEC teams in the 4-team postseason playoff. It's moving 2024. It's going to be 8 teams.
Does it
by the
involve
way.
cheating?
Does not involve cheating. LSU has to win out and beat Georgia, which is very low probability. But I've got a friend in the know that likes to wager on these things, and he's going to be taking LSU against Georgia. But anyway, so if LSU is currently number 6. This Saturday they have a night game, Alabama Birmingham in Baton Rouge. That should be an easy win, but they don't want to look forward to Texas A&M at College Station the following Saturday, and Texas A&M's coach's job could be on the line if he loses to LSU. He needs a signature win this year.
Well, that's a $90 million bill.
Oh, it is. But I mean, is Texas A&M going to let a loser stay there? So here's the deal. Tennessee is number 5. Georgia's number 1. LSU wins out, plays Georgia in the SEC championship. Georgia has no losses. They're just going to fall to 3 or 4. The loser of the Ohio State-Michigan game is likely going to be knocked out.
I'll be out.
And that leaves number 4 ranked Texas Christian University.
They would have to lose.
TCU. You know what's interesting about that, William, is they're playing in Waco this Saturday against Captain Shreve High School's Shapen. He's their starting quarterback for Baylor. The Baylor Bears. Is that what they are?
Always have been.
Okay. TCU invades Waco and the line is Pick'em. So I'd like to see Baylor step up to the task, knock TCU out of there, gives LSU a better chance to.
All right. So if TCU loses, TCU's out. If LSU beats Georgia, then you would have LSU, Georgia, and Tennessee.
Because
to the
Tennessee's fifth, you'd have all three of them in there.
Interesting.
That's very interesting. Although some people say that the committee would be political because the rest of the world would hate us down here and they would never let three teams in. But you've got, you've got 4 SEC schools in the top 8 right now. And it's like that every year. And it's going to continue. It's going to even get stronger because we've got Oklahoma and University of Texas entering into the SEC. So LSU, UAB Saturday night, and Baylor TCU this weekend. Those are the key games to watch. Give us a call if you have any questions or comments.
Who's
No.
doing the show next week? Are you
Oh.
doing it?
We're going to have to say it's the markets. The markets close, I think, 1:00 Eastern next Friday. And I have a beef with this whole thing because I don't think you've been in the office on a Friday after Thanksgiving in probably 5 years. So I'm saying
Yesterday it was 6 years.
I just want to let you know that I'm sending out my email to alert you that I will not be in the office on the Friday after Thanksgiving of 2023. One of you guys is going to have to pick up the slack
I was here
But-
last year.
because you're going to be AWOL this next Friday. I'm going to come in here and man the office and get some real work done. And
It's not nice to lie to clients.
I think so. So that's it. I think
Are we gonna let Jack do trades Friday?
we're not we're not going to have a Jack and Bill show next Friday, but we want to wish all of our clients and viewers and friends and family and all that a happy Thanksgiving. Because if it's anything like what we're going to have at my house, it's oftentimes rather dysfunctional.
I can't cut that out.
I'm sure we're used to that.
I hope no one in my family's watching.
No, they're not.
Happy Thanksgiving to all. See you next time.